Just to you on the outset here with the 10 capital raising now confirmed. Analysts seem to predict more trouble ahead. It's kind of a continuation of the same old story. What do you think the market makes of this latest development, though, of actually confirming that capital raising now, the one that they said 2 months ago they wouldn't need?
Brooke, yesterday we were talking about the debt covenants of 10 and how they were quite close to it, and really this gets it out of immediate trouble. The $230 million capital raising means that it ends up with a net cash position of $45 million. So in terms of its actual balance sheet, it gets it in trouble and out of trouble in terms of its covenants. But in terms of the underlying business, really what investors are looking for today from the AGM is the outlook for 10. And it does look like conditions have deteriorated from October. So conditions are tough. We know that 10's in cost-cutting mode. It is aiming to cut about $35 million worth of costs in the current financial year. But its problem is that the revenue outlook is deteriorating. So at a time when revenue is deteriorating, they can't really cut costs fast enough. This is a business with a high fixed cost base. They are trying to reduce that high fixed cost base. But altogether, what we really need to see is an increase in ratings, because there's an extremely high correlation between revenue and ratings at the television stations. And we know that 10 has been losing market share throughout the last year, and really we need to see some strong programming coming through from 10.
That one, shall we? And just, Julia, reflect on today's session. We got a rally yesterday, a significant one from Shanghai into the close. The importance of that market maintaining its momentum through this session.
Absolutely. It was a very impressive performance coming through from the Shanghai Composite, up by 2.8% yesterday. And I think that's going to have a flow-on effect to our material space. We didn't see a strong lead coming through from commodities overnight. In fact, gold was down by 0.1%, and that was actually at a one-month low. We also saw oil prices down by 0.7%, and the CRB index was down by around about 1%. But I think the fact that we are seeing some strong support now coming in for the Shanghai Composite does bode well for our material space. So this is an area that we are expecting to outperform today. We've also seen a positive lead coming through from the US, although the SPI futures this morning were only up by 0.1%. But this week is also jobs week in the US as well as in Australia. Overnight we got the US ADP jobs report. It did come in weaker than the October numbers at 118,000. October was 158,000. But of course domestically we're going to be focusing in on jobs. We're expecting to see an unemployment rate of 5.5% and 5,000 jobs being lost. So this is an important one because it will feed into interest rate expectations. And of course it's been a little bit rocky for the Australian dollar. It hasn't performed the way that markets would traditionally expect with an interest rate cut, and also that softer GDP numbers coming out yesterday. So it's going to be interesting to watch how markets react to this one. Usually if we get a soft jobs numbers, that increases the chances of an interest rate cut, and that's usually a negative for the Australian dollar and a positive for the Australian market. But it's going to be interesting to see whether markets behave in their traditional ways.
Move on, Julia, just time to talk Boral and the A dollar, and the connection there, it's not exactly a kind one.
No, if we have a look at Boral, we've had some news out this morning that they have suspended their clinker output. Now, this is an ingredient that goes into cement. But if we have a look at Boral as a business, it's a cyclical industry, and we know that it's been quite tough in that building and construction space here in Australia. And so that provides a strong focus, and most companies do this when they are looking at a cyclical downturn, a strong focus on cost cutting, and that's really what we're seeing from Boral. The strong Australian dollar means that it doesn't make sense for it to be looking at producing its own clinker. Instead, it's looking at cheaper imported products, and that's really what it's going to be doing going forward. Now, the clinker manufacturing or the output base has a book value of about $100 million, so we could see some write-downs there. But the key is that the Australian residential construction market still remains very difficult. The US is looking better, but the US business is still yet to break even, and this is a business with high gearing levels, gearing of 45%, and interest coverage is quite weak at just 2.3 times. So Boral looking at other ways for cost cutting, and we're expecting to see this continue given the difficult conditions in that construction space here in Australia.